Okay. And I noticed something, just trying to fix that quickly. Just trying to fix what I've noticed quickly, and for us to commence the class. That will just take in next 1 minute. Okay, I think that is fixed now. I have that here. Okay, so I can move this there to replace this. Okay. Then I am cool to go for today. All right. Good evening, everyone. I hope we are doing well, by God's grace, and I'm happy to be here today to talk to you about commercial bank valuation. And we started discussing this. That was yesterday, and today we have some few things to look at again. I I think the best way to learning how to model a commercial bank value is understanding the the economics of the banking sector as well, really well. We started something really good last or yesterday. We looked at the business of banking and how that affects the manner in which we do the valuation. And so today will be a very interesting time again. You have looking at some of these things. So let me just share my screen quickly so that we can commence the lecture for today. Okay. And let me, if you can see my screen, once you're able to see my screen, please give me a thumbs up if you can see my screen shared. Is my screen, is it visible? I don't know whether there's some few pages there and there that's just automatically. I have to quickly close. Now I guess my screen is visible now. Okay. Okay, please can you see my screen? All right, so let me check the chat. Yes, 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 yes. All right. So let me see whether there are any questions. It will be useful to get yesterday's recording. Oh, okay. Thanks for the notice. The slide will be shared. Okay, good, good, good. Great. Thank you very much. And I'm happy to be here today to take you through this. So we started this yesterday. We looked at the nature of commercial banking, the business model, and how that affects valuation ultimately. What we're going to do today is to look at some economic issues that affect the banking sector. And my objective is that that will set the center stage together with what we did yesterday. And then from tomorrow, we will get ourselves introduced for the first time in this lecture. We get ourselves introduced to multiple approaches to estimating value. And that will test our understanding, or maybe get us prepared for the task ahead. And when I say the task ahead, I mean the modeling and all those kind of financial statement modeling, all those kind of stuff we're going to be doing later. So that's just to prepare us for us to know why we are even doing financial statement modeling. Is it something necessary we need to do, or we can just focus on, let's say, just picking an item on the historical financial statement and the story there. So today we are going to continue with the module one, and we'll complete the module one, and then we will be left with, I think, 4 more modules to complete. The module one is on business and economics of banking. So today we will discuss the macroeconomic analysis and banking, and let's get into that quickly. So I'm not going to run these like a classical economics class. And there are lots I'll be talking about. There are lots of figures there and there we're going to be discussing. And also, we will be linking a lot of things to what is happening in the banking sector. In some cases, I'll be using data that relates to all banks in the sector. I think I was working with some top 20 banks, not to say top 20 banks, but I gave you the facts that the time those data were put together, some banks were not having their financial statement published. So I was working with just I think 20 banks out of 23. Okay, and also I mentioned that in some cases we may focus on just top 5 banks. Of course, they are especially when I'm looking at data in 2024. So we'll be focusing more on the top 5 banks. Now, so the banking sector in developing economies is what drives the economy. And unlike the developed economies, like the United States and co, the stock market tends to explain almost like 70% of the GDP. In other words, of what happens. That's the reason why in the US and all that, they can use the stock markets to infer whether the economy is reviving or not. And usually when that is done, you see a lot of analysts and politicians talking about the S&P 500, which then tend to be considered as the best index to track the market. In other words, S&P 500 tracks the top 500 firms in the United States. So those top 500 firms have huge market capitalization, and they tend to drive the economy. And that's more reason why in the United States, you tend to see economic models being very useful, because suppose you are coming out with a model to predict maybe corporate profitability or corporate value, whatsoever, or whichever way you want to look at it. And so you are coming up with an economic model that is tracking the performance of a corporation. And then you are using macroeconomic variables like GDP, interest rate, inflation, and all those stuff in the model. Let's say a regression model, right? Or maybe even doing some machine learning work. And so you're doing that, and then let's say the corporations, or if I say corporation in this case, I'm relating to the stock market as well. There is no strong relationship between what happens on the stock market and what happens in the economy. When that happens, you see that you'll be building a model that may be difficult to implement. In other words, the R square of the model may actually be extremely low, and especially in regression models. So many times we look at the macroeconomic variables, but then also we ask questions, can we build a model using this? And it's a matter of whether historically the macroeconomic variables actually interpret or maybe predict the dependent variable we want to look at. You see, so bringing the argument back to the developing economies like Ghana, Nigeria, and all that, the banking sector plays a key role in the sector in the economy. And so the growth in the economy is mainly driven by availability of credit and all that. If we look at it generally in Ghana, the stock market is not that active that we may consider, especially if firms want to raise equity capital now, they'll struggle to raise equity capital on the stock market, especially if you're a firm that's not quite popular out there, right? Now, so you may be resorting to getting money from the private equity guys, or maybe, of course, the easiest place to go is the banking sector. You approach your bank for credit, right? Now, but the banks are in the economy here, and anything that happens to the economy is likely to affect the banks. Now, so when we look at the performance of the economy, and we see that in developing economies, usually the banking sector tends to dominate the economy, then we will say that whatsoever happens in the economy is likely to have an effect, or in the banking sector, is likely to have an effect on the economy, and vice versa. So, well, just to mention this, when we had the DDP program, of course, the government have to float some bonds to raise money to recapitalize the banks. It affected the economy negatively, of course, because think about a situation whereby the government have to increase its debt, and the servicing of those debts may bring additional troubles in the form of high inflation and depreciation of the currency, and that causes interest rates and everything to be rising. So everybody tend to face the impact of that initiative that's taken. So what I want to say generally is that the economic waves affect the bank's performance, affect the financial institutions in the country generally. Now, so there are four economic variables that we're going to be talking about. We have GDP there, we have interest rates, we have exchange rates, and we have inflation. So we're going to be talking about those four. See how they look like. Now, so when we talk generally about GDP, this is a gross domestic product of the country. And I want to say that I'm not here to go into the nuances of each of these. I want to see how we use them, or how useful, in other words, the impact of this variable, rather than looking into the variables, how they're determined. Well, in some cases, I will talk about how they're determined, but that's not my objective, right? If you take the GDP, how we measure the growth in GDP, we can do that on the basis of a nominal growth or a real growth. When we deal with a real growth in GDP, that measure is not affected by inflation. We are actually looking at the real growth in the output of the economy. And that's the one that we can compare across board. So it will be difficult for us to compare nominal GDP across various countries, because the countries may have their own inflation measure. And not just that, how they even determine inflation may vary. But because of differences in inflation, comparing nominal GDP doesn't really help. So we tend to compare real GDP. And real GDP is the actual measure of economic growth. Think about a situation where a country is experiencing hyperinflation, and then you are likely to have the GDP of that country be extremely high. If you are using that to say, well, the country is growing, but the value of money is dropping each and every time. It's wiping away value. So where is the growth actually? So the actual growth is felt in the real GDP. So unless otherwise stated, when I say GDP growth, I mean real GDP growth. In fact, and that is actually the convention. I don't know if someone put a question, something. Please, can you explain how the banks recapitalization affect the economy? I think I'm going to get into that soon. It's part of what we're going to be discussing today. So that will actually be addressed. Now, so when we take the GDP, for example, what's the impact on the sector? Well, a growing economy means that GDP is expected to grow. Then we say economic growth, right? We expect a higher economic growth. High economic growth means that economic activities are going to be on the high side. A lot of businesses are going to expand. Companies are going to produce because there's demand for the product that they produce, right? And that usually also calls for or attract foreign direct investment, right? Attract foreign direct investment because the investors out there have this mind that, well, the Ghanaian economy is expected to grow, and therefore investing in Ghana today is a good thing to do. So when that happens, demand for credit increases. But at the same time, if GDP is dropping or is expected to drop, then there's increased risk of credit default. The whole idea is, it isn't that a decline in GDP is going to result in direct impact on the company. In other words, like there's going to be, or there's certainty that there will be a high default or the loans will be defaulted on. But here we are talking about the probability of the loans going bad, right? So if the economy is expected to do well, then businesses are likely to do well, then you have stronger cash flows. And by implication, they are likely to settle their loans in a good economy. But in a bad economy too, the opposite is true, right? Now, so when we talk about interest rates here, and we are going to get into the details of each of these, but when we talk about interest rates, the impact on the bank or on the sector, think about it. The bank's business is entirely leverage driven, okay? The whole story is around interest rates. And if we take the profit or loss statement of a bank, the significant revenue comes from interest income, and we established this yesterday. The significant revenue of a bank comes from interest income. So if that is the case, then the bank should be concerned about interest rate. We also established that the interest income arises from two sources. It arises from the loans the bank has granted to customers, and also the investment securities. Those are the treasury instruments the bank has invested in. So the investment securities are not entirely just the treasury. We could also have corporate bonds or corporate securities that the banks might have invested in. Now, so a change in interest rate affects the value of those assets and liabilities. In other words, it's going to affect the P&L because the asset and liabilities, the asset and liabilities on the balance sheets there. I mean, in this case, I've been talking a lot about the assets, which is the loans and investment securities, and they bring out the interest income. The assets on the balance sheet and by extension, the liabilities are sensitive to interest rates. Apart from the fact that their valuation is sensitive to the interest rate, like for example, in the case of investment securities, the yield on them is also sensitive to interest rate, depending on the structure of the interest rate the bank is adopting most. If most of the loans are variable loans, then changes in interest rate is likely to affect the loan, the repricing of the loans and all that. Now, I have not yet started talking about interest rates as to the type of interest rates we have, but generally, when we say interest rate has increased or interest rate has decreased, let's just say in Ghana here, we talk more about the monetary policy rates as the fundamental interest rate around which or on which several other interest rates are built. And we're going to be looking at a simple model for building one of the interest rates soon. Now, so the interest rate affects the assets and also affects the liability. On the side of the P&L, because interest income is generated from the asset and interest expense is generated from the liability, the net of that, which is the net interest income, then becomes sensitive to interest rates. So we have net interest margin being affected, and possibility or the need for a loan repricing arises for banks in a high interest rate or volatile interest rate environment, especially what we experienced somewhere around 2022, 2023. Now, exchange rates is a key thing as well. You see, we want exchange rate to be predictable. So high volatility in exchange rate affects the bank's P&Ls as well as the balance sheet as well. Now, think about it. If a bank grants an FS loan, in terms of, especially the corporate banking desk grants loans to corporations, and let's say a syndicated loan, and maybe a significant amount is granted in in USD. Now, the natural thing anybody would think about is that, well, if the dollar appreciates, then more money will come to us or to the bank in CD10. But that is not the source of the risk. The risk here is that if the dollar appreciates significantly, the customer may not be able to pay back the loan or honor her obligations as and when it's due. So that raises an FS loan risk. Now, because a customer may not pay back the loans, a number of the loans may end up becoming non-performing. And non-performing, some may result in 100% provision being made for that. All this will increase the risk asset base of the bank. Now, think about it this way. FS loans are very risky. Apart from the fact that they are interest rate sensitive, they are also exchange rate sensitive. So there are two sources of risks we are looking at here. If we compare these to a loan granted by the bank in a local currency, the key risk here is the interest rate. Well, there's a bit of a credit risk here as well, but let's just look at it at the level of the interest rate. Now, when we grant a loan in USD, then it's not just the interest rate that matters, but also the exchange rate matters. So two sources of risk affecting the bank now. And that increases the potential for losses to arise. And as a result, you'll be required to have enough capital to absorb those losses as and when they materialize. And so the capital adequacy ratio of the bank may be affected. Now, talking about inflation, the whole idea a lot of people have is if inflation is rising, what happens? Banks will reprice their variable loans. Of course, the variable loans that those are loans that the interest rate is set in reference to a benchmark rate. And there are several types of benchmark rates. In Ghana, the commonest benchmark rate, especially for consumer loans that are being priced, is the Ghana reference rate. And we'll talk about that in a moment. Now, so when inflation increases, you are likely to have some of those loans repriced for a reason, because the initial interest rate you have will have some expectation of what inflation will be. So if those expectations change, then there's a need for revision to the interest rate. And that can easily be done well when the loans are variable, because the GRL itself may adjust accordingly. But if we have a fixed loan, a bank that has significant proportion of its loan being fixed, then that's where we see problems arising, because it's not going to be easy for you to call back those or call the customer's bank and say, well, I want to adjust the interest rate. That may be a bit difficult to do. Apart from the asset liability issues associated with inflation, the other matters like costs is also a key thing to look at, because the bank have operating expenses or they incur costs regularly, and these costs tend to be affected by inflation. So personnel costs, once the economy worsens in terms of inflation, price of goods and services increase over time, the bank may be forced to adjust compensation to employees. Beside that, we may also have other operating expenses, IT, utilities, and all that are also adjusted. So all these affect the bank's performance because of inflation. Now, so it's very difficult to hedge against inflation as far as all these are concerned. Another point is this. In Ghana, you even see the net profit of, so that's the earnings, right? The earnings after tax, I mean. The net profit of the bank rising at a very significant rate. I think I showed you something like that yesterday. And you'll be wondering how. But if you decompose this, you see that the significant rise in the net profit is actually driven by inflationary pressures. If you look at 2024, for instance, GDP growth was about 5.7% recorded, and the policy rate stood at 29.95%. And the CD depreciation, year-end CD depreciation around 19%, and the end of period inflation is about 23.8%. That recorded. Now, if you look at it, you see clearly that the policy rate sits above the inflation. Of course, the policy rate exceeded the inflation, 29.95% against 23.8%. The GDP growth rate, as I stated earlier here, is a real GDP growth rate and not a nominal GDP growth rate. A simple analysis that may be roughly correct, which I use also some part of the lecture today, will be to add the GDP growth rate, the real GDP growth rate, to the inflation, and that's likely to give you an approximation of the nominal growth in GDP for the country in 2024. So those are the basic variables that we're going to be talking about in some details. Okay. Now, the whole idea is this. When we model in a bank's financial statement, we're going to come up with assumptions. The assumptions need to be consistent with certain things. Number one, whenever I do financial modeling or I supervise the work done by junior colleagues on my team on the banks and all that, the guiding principle for the assessment of the reasonability of the assumptions we use usually four for me. Number one, macroeconomic context must be consistent with the macroeconomy. And so when I take the assumptions should be evaluated in the context of what's happening in the economy. That's one. Number two, the assumptions should be consistent with what is happening in the sector. And three, the assumption should be consistent or should take cognizance of what happened in the past as far as the bank is concerned. And also, when I'm talking about the sector, I'm talking about what happened in the past and what is likely to happen in the future as well, as far as the banking sector is concerned. And the fourth one is management plans, the plans of management for the future. So the assumptions must respect those four areas. And that's the reason why macroeconomic analysis becomes key. And that's the reason why sectoral analysis is also key. And we need to do all these when we're doing financial modeling. And we are valuing a bank in the context of this economy. And when an investor outside there in the United States want to invest in a bank in Ghana or buy a banking stock in Ghana here, it's not just going to think about, well, I'm just buying a bank. No, it's going to look at the entire risks of the country as when evaluating whether or not to buy that bank. So the country risk is very important. And some of the key determinants are the things we are looking at now. I think there's a question here. Are you aligned with something Benjamin Graham said in his book, The Intelligent Investor? I think I might. Okay, The Intelligent Investor, that inflation help and contribute to the earnings of companies, including banks. Oh, yes, inflation contributes to earnings of banks. However, we need to look at that in the short term and also in the medium term. In the short term, it's going to contribute. In the medium term, well, high inflation is contributing in the short term because interest rate is adjusted and the bank's earnings are growing. But in the medium term, a higher interest rate may deter people from bank credit. That's one. Number two, those who already have the credit may default. There's an increased risk of default. Because of an increased risk of default, even though they've not yet even defaulted, it may result in significant expected losses recorded in the books. And in other words, your impairment is going to rise. A rise in impairment affects earnings. This is the bottom line as well. So that's how inflation plays its game, right? The figures, end of year 2024 figures. Oh, well, the GDP growth rate is the rate for 2024, policy rate. I think this should be end of 2024. Depreciation of the currency is by 2024, and inflation is end of period 2024. Okay. Well, Well, it depends on sometimes the source of your information and how. So I like the question how some of these things are calculated because you can get data from another source and maybe the methodology used in the computation of the figures here may be different, so you may end up getting something slightly different. However, my objective here is to show you something. So anything I include in these slides are for educational purposes. Let's get into GDP and sector performance. Looking on this slide here and taking the first statement at the top. So higher expected GDP growth implies an expansionary economy. An expansionary economy, as I mentioned earlier, is going to result in a higher demand, or it's likely to result in a higher demand for credit and potential decline in loan defaults because companies will then have stronger cash flow. However, as to whether this will happen depends on the sectors the bank is exposed to. So when you are reading a bank's financial statement, you want to see the sectors it's exposed to in terms of where it grants its loans. Now, let's look at two groups of sectors. One sector that is exposed to the business cycle and one that is not exposed to the business cycle. Let's take sectors like construction sector. Construction sectors tend to be exposed to the business cycle. So this includes the real estate and all those sectors. Now, so if the economy is doing well, that sector will do well. Therefore, you will not expect higher default arising from these sectors. And when the economy is doing badly, those sectors are likely to do badly. Now, if you think about other sectors that, let's say, they produce or they produce, let's say they provide non-discretionary services or produce non-discretionary goods, they are likely to be less cyclical to the business cycle. So those involved in let's say, food, okay, food vendors and all that. The hospitals, I mean, the basic hospitals will provide basic services, and those involved in food. Now, just think about it. Or let's think about those involved in telecommunication, like MTN. Of course, people by all means make calls, whether the economy is good or bad, they are still going to make calls. Just that they may not be able to afford some services, but they are going to be making calls, especially you are in a country where maybe the competition among the telecommunication firms is quite non-existent, if I should put it that way, because of the significant market player, which is MTN, right? So they are not likely to be affected by the business cycle like that. Now, because they are not likely to be affected by business cycle, if the economy is booming, you don't expect significant growth in the revenue of MTN. But when I talk about the banks are pro-cyclical. Okay, so they are pro-cyclical, while the other ones are counter-cyclical. The banks are pro-cyclical, so if the economy is doing well, the banks are likely to do well. If the economy is doing badly, the banks are likely to do bad. Sometimes the waves actually comes from the banking sector to the economy, sometimes from the economy to the banking sector. Now, why am I saying this? Think about it this way. The government wants to build more roads or maybe expand on infrastructure. One way the government, or two ways the government can do this are, number one, they're going to raise taxes, so people will pay taxes. But if they don't have enough people to tax, or the tax base is not that good to raise the money they want to raise, the next thing they're going to do is to borrow, which government always do. So they are going to borrow by issuing securities, which we call the treasuries. They are called treasuries because these are securities issued within your borders. If you issue the securities out of your jurisdiction, we don't call them treasuries anymore. Now, so they are called treasuries here, what the government issues. What is going to happen? The government would like to get money, because the government wants to get money. What is the government going to do? It's going to increase interest rate. Or I can give it to you at so and so rate. So the banks look at it and feel like, well, instead of moving money to the private sector, why not rather give the money to the government for something, quote and unquote, a guaranteed return? And then they do that. So what happens? The demand for government credits or government instrument increases. And then before the banks will be convinced to lend money to the private sector, they must be willing to take on a higher interest rate. And therefore, the interest rate to the private sector tend to be higher. And that whole story, most time we call it the crowding out effect. Now, so if the government is borrowing money to build rules and all that, what the government wants to do is that it wants to revamp the economy, to pump in money out, they do project, increase government expenditure. And if you look at the national income formula, the formula for GDP, an element in the GDP formula is government expenditure. So government expenditure, once government expenditure increases, what happens? We expect a growth in the economy. So government expenditure is increasing. And how is the government financing this? It's financing this by borrowing from the private sector. Now, the situation gets worse when external or foreign investors are not comfortable with the country. If foreign investors are not comfortable with the future of the country, even if the government is willing to offer them higher interest rates, they will not take it. Now, but the initial thing the government will do is to increase interest rate. Once it increases interest rate on the treasuries, then the foreign investors may be attracted to buy. But the issue here is this. If the government increases interest rates and the foreign investors still not consider the country as fundamentals as being strong, they are still not going to buy. So the interest rate is going to remain high and the banks will be chasing that. And as the banks chase that, then the banks may not have enough liquidity to provide to the private sector. Then there's a problem again. So the private sector may be getting these loans at a very high cost. They run the business doesn't do well, the margins are not strong, and then the loan default continues. These are the challenges. And a lower GDP growth expectation has the opposite effect. Now, if you look on the screen here and what I'm showing, the graph I'm showing here, you'll see the loan growth, and this loan growth, the growth in loans of the sector, okay, the sector loan growth. Now, in 2016, of course, the banking sector wasn't growing that much. Of course, that's why we have serious troubles in the banking sector, a pre-cleanup phase, 5% growth in the loans. But I want you also to be careful here when we talk about loan growth. The loans I'm using here are the net loans or the loans on the balance sheet. The net loans don't reflect the story. It doesn't tell the story accurately. But you see, the situation is quite some way, because if I use net loans, there are a lot of things that are going on in there. The net loans are the gross loans adjusted for things like non-performance, that's impairment, and then also there are a lot of things that are going out there that the gross, of which we'll be talking about, the gross loan get adjusted by to arrive at the net loans. So if you are looking at net loans and you see net loan not really rising, it doesn't mean that the bank may not be granting loans. But what it might mean is that a lot of loans that they've granted are becoming bad. Now, but then we can still tell the story with the net loans here for the banking sector. So we saw a decline 2016 to 2017, of course, and the cleanup happened right after the cleanup. Net loans, the banking sector jumped up, and that's the story that a lot of the politicians were telling. That of course the cleanup program was successful, to say that well the loans on the sector balance sheet has increased significantly. But I see a drop again in 2020, and this should be clear to you why the sector loan stock dropped in 2020. I mean the growth in the sector loan dropped significantly. It dropped from somewhere around 40% to I think it was 0.2% or so. Oh, sorry, 2%, not 0.2, 2% at all. And you know why this happened? The COVID-19 caused this to happen. So a lot of businesses were adamant to go for credit. So that resulted in that. Because I know that COVID, we actually felt the aftermath part of the COVID, but not during the COVID period. During the COVID period, you still see a lot of things. Interest rate is still stable and all that. I mean, in 2020. But because businesses were alarmed, they don't want to go for credit to start anything now, and then the COVID is going to destroy it because there was a lockdown period and all that, and that's affected the loan growth. And then we saw a recovery to 2022, and in 2022, a drop. The 2022 hasn't even, should have increased more than this, but for the debt exchange program. And after the debt exchange program, the banks were trying to recover. And of course, 2023, you see that there's a significant drop here. No, let me correct something. What I'm showing you here is the top 5 banks in the country because I have 2024. I should have labeled this properly, the top 5 banks. And I mentioned the top 5 banks before, the Eco Bank, GCB Bank, Fidelity Bank, Stanbic Bank, ABSA. So I mentioned Eco Bank, Fidelity, ABSA, GCB, and Stanbic. Those are the top 5 banks by assets and deposits. Now, so if you look at this, they are the ones showing this. The top 5 banks, the big guys on the market are the ones showing this. And I showed you yesterday that the top 5 banks contribute or control about 74% of the customer deposits. So think about that. Or the top 10 banks, the top 10 bank control that. So the top 5 are controlling something in the 50% and all that. And that's quite significant, right? Now, if you look at deposits have not really been that volatile compared to the loans and quite stable. But deposit tends to be going alongside the nominal GDP. I use nominal GDP here because the loan growth and deposit growth are not inflation adjusted. There's an inflation element in the growth in loans and the growth in deposits. So because they are not real values, they are nominal values that are used to calculate growth, I say there's an inflation element. That's what I mean. You are using real value or you are using nominal values for the computation of the rate of growth. Therefore, we have a nominal growth rate. So comparing that to a GDP growth rate without adjusting or leaving the GDP growth rate unadjusted will not reflect the truth. But just look at the relationship between deposit growth and nominal GDP, and that's quite interesting. Not quite perfect, but you'll see that from 2021 they started having this close relationship. They both match. They match in 2021, and then they rose together. They drop again, but then the deposit tend to be a bit resilient in 2024 compared to the nominal GDP. And that is what is happening in the country. But think about it, if the economy is doing well, the economy is expanding, you'll see it in the bank account, right? A lot of people will be depositing money, people will be doing transactions, and they're likely to have a lot of money in there. But there's something I want you to know, and that is that the mobile money services, I mean, the fintech companies are also competing for the same deposit amount. So that's affecting the deposit trend. But largely, we can establish some relationship between the nominal GDP growth and the deposit growth, and by extension, the loan growth. And we're looking at this between 2016 and 2024. And that's about 9-year period. And that is interesting, the trend we are seeing. Great. I'm not sure I have any question here. I can proceed. No question yet. Let me proceed. Now, so we just talk about GDP and sector performance. Now let's talk about interest rates. So, well, you see, the fundamental interest rates or the basic interest rates here we have in a country, and whenever we talk about interest rate, is the monetary policy rate, or what we call the policy rate, which used to sometimes be called, I think, the bank rates, and another time, I think they call the prime rates, right? Now we have the monetary policy rate. Now, so the monetary policy rate, the objective is for monetary decisions, right? The Bank of Ghana is the one in charge of that. They set these rates, and these are the rates at which the banks can borrow from the central bank, right? That's the monetary policy rate. And the whole idea is that if that rate is used to infer the economic fundamentals in terms of growth, short-term growth and all that, it's not supposed to be considered a long-term rate. It's more of a short-term rate, and that's why it is reviewed regularly. It's a short-term rate rather than a long-term rate, and so I wanted to take note of that. Now, so the policy rate, because it's a rate that the banks can use to borrow from the central bank, the banks then use it as benchmark for determination of other rates. We're going to see something soon. And so if we see the policy rate rising, and what I'm calling the transmission mechanism, when we see the policy rate rising, what happens is that the interest rate on the loans also tend to rise, all of that things being equal. Especially the floating rate loans tend to adjust, right? Now, so we see the loan rate rising, and then that will result in margins expanding. And when we say margins here, we mean the interest margin, the net interest margin, which we will be talking about in detail soon. So the net interest margin tend to expand. And what that means here is this: if we have, let's say, the interest income, and we have the interest expense, if we take the interest expense out of the interest income, it gives us the net interest income. Now, we can say that the interest expense, of course, if we express interest expense on, let's say, deposit, it gives us what we call the cost of funds, or the average cost of, raising money, or the average cost of mobilizing deposits, or maybe getting funding from borrowings, right? Now, we can consider that to be upward sticky to a large extent. Most banks will not want to just increase that. Anyways, the reason also is that there's competition for deposits, and everyone wants to attract. Let me take my voice back otherwise, but I'm going to talk about the competition as well. But the reason why they may not really want that to be rising is that a lot of banks are thinking about how they can get money from cheaper sources like CASA, right? CASA accounts, and that would be better. But the competition sometimes forces banks to increase that, especially banks that don't have competitive advantage. They tend to attract customers by maybe giving them favorable rates. So fixed deposits, then they give you a very high rate. They promise you a high rate. But the banks that have the high competitive advantage, like their dominant banks, like the top 5 banks, the likes of GCB, EcoBank, and Absa, Stanbic, Fidelity, they have a significant control over the market. So because of that competitive edge they have over other banks, they are not likely to be increasing their deposit rates in that manner. Now, so we consider the interest expense, or the deposit rate, or the cost of funding to be a little upward sticky. And then, so when we see the policy rate increasing and other interest rate like DRL and all that follows that, and it keep increasing, what happens is that the difference, or the differential, which is the interest, the yield on the earning asset, which comes from the interest income, and the cost of fund, the margin tends to expand, and which is a good thing because it improves upon the profitability of the bank. But what happens also is that because the loans are being repriced, then now the banks will not be able to get enough attract customers, because customers will be complaining, well, it's costing us too much to actually raise credit, and the demand for the loans will drop. All of that things being equal. When I say some of these things, I'm not trying to say that will definitely happen, but there's high possibility that such a thing will happen. That's what we're trying to say here. Now, so, well, if you look on this graph here, I think a question, is there a question? Please, what is CASA? CASA is current account, savings account. Yeah, CFAS, thank you. Now, looking on this graph here, we have the lending rate and the loan growth. So if you look at the lending rate is in the red. So 22%, this is the average commercial bank lending rate, right? 22%, 21% in 2020, 2021, when interest rate was stable. And then in 2022, when we started experiencing a high inflation, what happened? We experienced very significant inflation in 2022. and the average commercial bank lending rate increased to 26% from 21% to 26%. In developed market, this should be a very high rate. You know, it appears that several banks took time to reprice their loans. So you can see that it is in 2023 that they experienced significant rise in interest rate. Of course, in fact, the impact was actually felt around here. And maybe wondering that, well, you've seen GRR rate and interest rate about 40-50%. Why this? Well, this is an average rate, right? Average reported rate, 33%. That's significant. And then, but then again, a drop in 2024 to 31%. But I want you to see what is happening here. When interest rate was stable, look at what happened to loan growth. Okay, now the loan growth here I'm looking at again is the top 5 banks, right? Look at what happened to the loan growth. And then we still have the loan growth or the loan growing, loan base growing. A lot of people are still taking credit. So that has grown actually. But look at what happened in 2023 when interest rates started rising. See the drop, the sudden drop. The sudden drop. That's quite significant, right? And interest rate was up here. And look at the drop in the loans. And then, well, in 2024, recovery, right? We experienced some level of recovery and credit started picking up again. Well, so there are several ways to explain this. You see, economics is such a way that there are several explanations you can provide to whatsoever happened in the economy. And one is to say that, well, the interest rate is the reason why the demand for loan dropped. Another one to look at is that, well, because of what happened in 2022 when interest rates started rising, a lot of people prefer to wait for interest rate to drop before they start taking on new loans. So that's the reason why that never happens, right? So as I said, the growth in the net loans of the top 5 banks in 2023 fell because 2022 and 2020 reflected aftermath below 2022 and 2024, aftermath effect of DDP. Okay. And of course, that's where we started having a higher rate and inflation as well. Now the whole idea too is that with the interest rate stuff is that the banks with high CASA ratio, that's current account, savings account. And I tend to use the CASA because the current account don't attract any interest. And the interest on savings account is quite minimal, right? So banks with high CASA ratio to total deposit, you see those banks tend to have a lower cost of funds. And they tend to win in a high interest rate environment because it doesn't cost them to mobilize deposit that they are going to use to create loans. It doesn't cost them to mobilize deposit. So if you look at it, for example, EcoBank between 2018 and 2021, the CASA to total deposits 90%. Imagine 90% of the deposit of EcoBank between this period was from current account, savings account. So other expensive sources of deposit like time deposit are not problems here, right? And so they don't have to increase interest rate to attract any deposit. People are actually bringing in money, and CASA doesn't cost money. Okay, so they tend to win in a high interest rate environment. You see how we're doing the work, what we are looking at. We are not just discussing the economy or whatever, but we want to see the relevance of whatsoever we're doing to the valuation we'll be doing. We want to understand the banks well. We want to understand the bank's financials really well. What is actually driving the numbers? We want to understand the story behind the bank's financial statement, the story beyond the financial statement. Can we interpret this in the context of the economy? That is what we're looking at, ladies and gentlemen. Great. All right. I think there's a question somebody's asking. So what caused 2022 to be different from the other years, away from the usual negative correlation between loan rate and lending rate and loan growth? I don't, if you have mentioned that, let me take it again. What caused 2022 to be different from the other years, away away from the usual negative correlation between LR and LG, I don't know if you have mentioned that. Oh, okay. Oh, yeah, definitely. You see, well, in 2022, because of the high inflation, a lot of things happen in the economy. Let me just go back again. Let me just go back again to show you this. So, well, in 2022, if you look at it, I've not shown you, this is just a nominal GDP. Maybe if I've shown you the real GDP, it may, but real GDP wasn't quite bad actually. But the whole idea is that interest rates was high, inflation was high in the economy. A lot of people or businesses were not prepared to invest. Okay, they want to take their time, and that results in that. And number two, to issues of default also might have increased. A loan default might have increased, and that resulted in the loan growth declining. It's not like the loan book is not growing. What we are saying is that it's growing, but it's growing at a decreasing rate. So because the growth in 2022 was 29%, and then the growth dropped to 11%. Okay, so we are not saying it's not like people are not taking credit, but the way the manner or the level of demand for credit has dropped. Right? That's the whole argument here. And has dropped because of a higher rate. General rate in the economy was high. 2023 interest rate was extremely high. Right? 2022, 2023. Interest rate was extremely high in 2023. All right. Is there any question again? No. Now, so we spoke about GDP, we spoke about interest rates. I want us to talk about FS. Now, so that was the third macroeconomic variable I want to talk about. So now, so the bank's foreign currency denominated interest bearing or marketable assets and liabilities are significantly affected by exchange rate volatility. Now, so on the balance sheet of banks, what we tend to see, we see the assets, we have the liability, and some of the assets, and I told you when I say assets for banks, I mean the loans and investment securities, other than the fees asset, unless I clearly state that I'm talking about fees asset, right? Now, so the assets on the bank's balance sheets are interest rate sensitive, but if they are denominated in USD, then they are also FS sensitive. Now, the financial statement are prepared in CD. However, those liabilities and assets will have to be translated to CD at every reporting date. And so if the currency is not stable, the CD to dollar rate is not stable, the balance sheet is going to be affected. That is the story we are trying to tell here. Now, so if a bank has a significant portion of its assets denominated in a foreign currency, then there's a problem. Now, these things are difficult to hedge against. But let's look at it this way. If we say foreign denominated asset, it could result from, let's say, a syndication process, a loan granted to a corporation maybe in dollars, or maybe through a syndication, or maybe through just a single bank financing that is if the bank can take on that risk onto this balance sheet, like a single obligation limit is not breached. At the end of the day, if the exchange rate changes, or exchange rate, is quite already volatile. So the depreciation of the CD will affect the value of the loan. Now, you may be thinking that, well, if the CD depreciates, it's to the benefit of the bank, because now the USD value of the loan, when translated to Ghana cedi, will be a lot. So the bank's balance sheet will expand because of depreciation. That is true. But you see, that is just in the short term. Because in the longer term, you are increasing the risk of defaults, because the customer may not be able to pay. They may have to write off all those loans. And that's going to hit your P&L and will cause more variability or volatility in your earnings per share. Okay, now, so that's why this is very important. It's not just about, well, what will benefit the bank today. When we do evaluation, we are looking at long term, right? And I told you that the key thing we are looking at when we do valuation most of the time is that that absorbs the losses for the bank, which is the capital. The capital is the key or the most important thing. The question is whether the bank has sufficient capital to cover all these risky exposures that it's having. Okay, having loans granted in USD or having a USD deposit, okay, or having a pound sterling deposit, or having, let's say, a euro deposit. Okay, so the risks the bank is exposing itself to, the question is, does the bank have enough capital in case there's a problem to absorb those losses? So when we do valuation of the bank, you can actually give a discount to the bank's book value just because of this. You can discount the bank book value, apply a discount, right? We can call that an FS risk discount, depending on how significant the bank's position is in FS. Now, so I presented something here in the table. What you see here is ABSA Ghana 2024 exposure. Now, so this is an extract from ABSA's financial statement, audited financial statement for 2024. So when you check that, total foreign denominated assets of ABSA stood at 8.4 billion. And now, so this foreign denominated asset is not just loans. It includes other assets like cash and cash equivalent and all that. And they are in multiple currency, not just USD. So multiple currency, and they are translated at the end of the period. And so that stood at 8.4 billion in CD10. And so when you compare that to the total asset on the balance sheet, that's about 30.81% of the balance sheet, of the asset on the balance sheet of ABSA. Now, so when we look at the foreign denominated liabilities too, this includes the deposit and all that in multiple currency, and in Ghana cedi about 10 billion, and that's representing 43% of the total balance sheet assets. So if I say percentage of total balance sheet, I mean balance sheet of assets and liabilities. So this 43% of the total balance sheet liability, and this 30.81% of total balance sheet assets. Now, a simple thing a lot of people do is to get the net position. If you take the net position about 1.6, don't worry about this. If you go into the financial statement itself, you see that it's about 1.5 something billion. But I approximated some few things here, and I don't want to put 1.5 something. Somebody may look at it and say, well, there's a problem with your work. I think your calculation is wrong. So I try to actually do 1.6 here. So when you take ABSA's financial statement, the audited account, or the annual report, you're likely to see about 1.5 something. But how's the story here? The whole thing trying to communicate from accounting perspective is that you have an asset of 8.4 billion in foreign currency. You have a liability of 10 billion in foreign currency, in local currency term, but then the equivalence is in foreign currency. So if there's any problem, you can use the asset to offset the liability, but up to how much? Up to only 8.4 billion. So you still have a net position of 1.6 billion. In business or in risk management, let me take my words back. In risk management, one thing we do will be to look at how we can hedge this extra 1.6 billion position so that we don't get exposed. The asset is covered only 8.4. You want to hedge this. But this is a problem. The hedging is not an issue here. The issue here is, what's the character of the foreign denominated asset? And what's the character of the foreign denominated liabilities? The character varies in terms of several things, in terms of the maturity profile of these and the nature of the assets we are looking at. If these assets are, let's say, a 91-day instrument or loans or short-term loans or something, you know that you can actually collect these and use to offset. But suppose the maturity profile of the asset is significantly different from the maturity profile of the liabilities, then it becomes very difficult to say that, well, you are effectively hedging this position by taking opposite side to the currency, right? So that's the difficulty here. Now when we tell the story in terms of the how FS actually affects banks, I want you just to see something here. So what I'm showing here, I think the years should have reflected it. I don't know why the years are not showing. I have NPLs and I have FS depreciation. So these NPLs are for the sector as a whole, right? Sector as a whole. And this is running from 2016 to 2023. I'm sorry if when I'm sharing these, I will ensure that the dates are there. Okay, so you can reference this properly. So from 2016 to 2023, right? Now let's look at it. Look at FS depreciation. So the depreciation wasn't significant in 2016, 2017, 10%, then 2018, 5%. Of course, we were in an IMF program that time, and things were a bit controlled. Even 2021, depreciation about 4%, and then we saw a 30% average depreciation in 2020. 2022 and 2023 we have about 25% depreciation. If maybe before I continue, let me look at a question here. I think someone is asking a question. On the previous slide, is the lending rate the average rate applied by banks, or it is the policy rate? No, the lending rate is the average rate that the banks borrow. So the reported commercial bank lending rate from all the banks. So that's it. The policy rate is different. The lending rate is the rates that the banks can lend to the public, and the policy rate is the one that the banks can borrow from Bank of Ghana, right? Is there a site where you can access this information, or you have to compute them manually using the company's financial statement? Well, of course, I have to do this manually, so I did all this manually, right? And someone asking, at what point does rising interest rate trigger currency depreciation? In an ideal world, I assume higher interest rate should. Okay. I'm going to answer this question immediately I'm done with what I'm doing. So I'll answer the question soon. Thomas, I'll answer this question soon. It's a very important question, a very important thing. Thank you for reminding me. So I'll talk about it. All right. So if you look at the non-performing loans, well, 21, 19, 18, 18, 16, 14. This for the entire sector, right? So it tells you that there are some banks that may be doing worst, maybe poorly in an aspect, and another bank may be doing quite well, right? But then one thing you see is that this kept dropping when the interest rate, when FX depreciation wasn't quite significant, right? In the range of 4% and 12%, which is quite acceptable, right? And then when we saw the spike in the depreciation in 2022, then we also started seeing NPLs rising. You see that NPLs started rising beyond that point and reached 20% here. But if you look at it previously, you'll be wondering, well, in 2016, NPL was 21%. Hey, don't forget the cleanup exercise. The cleanup exercise, what led to the cleanup was in 2016, 2015, 2016, and the concerns around the banking sector at that time, right? So it's true. But after the cleanup, you can you realize that the NPL situation started improving the sector. Then it started rising again this period. And so the FX depreciation is significant as FX depreciation. And you'll be wondering, what's the hell of in this world will I be comparing NPL and FX depreciation? The whole idea is that the banks have exposure. Some banks have significant exposure to FS. Okay, so when I say to FS, I mean the liability and the assets that I've just seen you here. So look at for example, ABSA, 30% of loans to exposed, 30% of assets exposed, 43% of liabilities exposed. So that's significant, right? So that could affect the trajectory, because if the currency depreciates too much, customers may default on loans. It increases the risk of loan default. Yeah. So that comes to what I wanted to talk about earlier, about the rising interest rates and I said that rising interest rates due to high inflation could trigger depreciation of the currency. Well, let's look at it this way. And I think somebody asked a question. So let me just take the question from there and answer. So Thomas is asking, Thomas, I think, at what point does rising interest rate trigger currency depreciation? In an ideal world, I assume higher interest rates should make CD assets fairly attractive. Foreign investors may prefer to save or invest in a high yield bond, and this should appreciate the CD in some regard. Yeah, that's true. But this is how it works. Let's look at this this way. Initially, when an interest rate is rising in an economy, foreign investors will enter the economy and they're going to invest in that economy. What do? They buy the bonds or invest in the stock market. or maybe through private equity routes, right? So if they buy the bonds of the government, they are doing so because the interest rate is currently high. They may invest in stock market because of a higher economic growth. And the same consideration is made when investing in bonds as well. But as they invest in the bonds, what happens? Well, they invest in the bonds, they are going to hold that bond, let's say, to maturity. Then what happens? They want to determine first if by the time they are going to exit they are going to exit that bond market, they want to see whether the currency will be stable enough. So when they are converting back to their home currency, the value will not be wiped away. So this is how it works. Before a decision like that is made, the portfolio manager or the researcher or the fixed income analyst is going to make some prediction about how the Ghanaian economy is going to perform. And by extension, how interest rate or how exchange rate is going to be perform or currency will perform. Now, so if they have their estimation that, well, we are going to hold this bond for 5 years. In 5 years' time, we are going to rebalance our books. So they'll project where the exchange rate should be in 5 years' time. And if then their calculation, they realize that they are going to make profit on the trade. So what do? They convert the money to Ghana cedi, they buy the government bonds, or in other words, they bring the dollars to buy the government bonds here, and they buy it in cedi. Now, the yield on cedi bond is going to be extremely higher than the yield on USD bond issued by, let's say, the US Treasury. Now, so in 5 years' time, they don't expect the cedi to depreciate too much because they will get a higher yield on the investment here in Ghana. But when they are translating that to USD, if the currency has not depreciated much, then they will make significant profit. But if the currency depreciates, then they may even make losses, even though they have invested in a high yielding currency. But this is the story here. As more and more money pops into the country, we call it hot money dropping into the country because of the high interest rate and all that. What happens to the currency? Demand for Ghana cedi increases because more USD is coming to chase the Ghana cedi. Foreign investors bringing in money. Demand for higher Ghana cedi increases. So when demand for Ghana cedi increases, it strengthens the currency. As the currency becomes very strong, then, well, it's actually going to affect a lot of businesses as well that have to export things in that way. So you see the currency becoming extremely strong. But then they will start evaluating. The investors, global investors are always looking for where the highest yield is, where they can get the highest yield. So if they realize that, well, there's a better country there that is going to give them something better, and also the economy of Ghana, the expectations for the future or the expectations for the economy is not that strong, and the economy is likely to die down or something or slow down, what are they going to do? They are not going to wait for that to happen. Suddenly, they are going to leave. So if they are leaving, what happens? They are going to sell the cedi. As they sell the cedi to buy the dollar, the currency crash. And that's the story of 2022. That's what happened to us. Just do a simple research and look at the value of the value of holdings that the foreign investors had before 2022 and after 2022, 2023, and see what actually happened to the country. And that's how the currency crashed. That's how the currency depreciated. It's about demand and supply. And it's also about the competitiveness of the country in question. Now to say this, interest rate is not the only thing that attracts investors. What happens often is this. When in Ghana recently, when the government needs money, they have to increase interest rates so that we attract foreign investors. Because foreign investors want to leave, they are saying that, well, the current rate, inflation is, or currency depreciation has wiped it away, so we are not getting good returns. So they would like to leave the market. But this is a point. What the government will do first is to say we want to increase interest rate. So they increase interest rate. If you increase interest rate so that you can attract those guys, they're not just going to be looking at today. They're going to be looking at tomorrow. Because if you look at interest rate generally, it's a real rate plus an expectation for inflation. Generally, that's what it is. So real rate plus expectation for inflation, generally. So if they expect a higher inflation, higher than even what the government is giving them, at the end of the day, they will still not be attracted. So the key thing that actually attracts foreign investors is not just interest rate, but it's about the economic fundamentals. The economic fundamentals, the expectations, the economic outlook, that is what investors are interested in. And of course, Vice President Baumia said that if the economic fundamentals are weak, the exchange rate will expose you. Well, that summarizes. That's a good statement, and that summarizes my point. Somebody's saying, what is NPL? Oh, non-performing loan. I will have to be writing these things down because I think there are a lot of people that are new to the banking sector. But I can tell you that we're going to do a lot of work on these things. And for now, I'm just taking you through the concepts, okay, for you to understand how the banking environment works. It's a bit different from what we see in the industrial corporates, right? Gideon is asking, do banks state the percentage of NPL on their financial statement? Yeah, they do. They do. They report that. They are required to report that. So the banks report that. As far as Ghana is concerned, I've seen it in almost every bank. They will state their NPL there as well. So you can see. Is there any other question? Is there any other question? Let me see. Any other question? Any other question? I'm not sure there is any. I think we can move on. Now let's talk about inflation. Inflation, well, the inflation tends to have a dual impact. Now, one is that, I think, let me check. I think someone has placed something in the, what is the criteria to classify a loan as an NPL? Oh, okay, so Gideon, well, regarding this question, we are going to address it later. I think either tomorrow or Monday. I think Monday we are going to address some of these questions. Yeah, we address a lot of this question on Monday, so just stick around, right? Good. All right. So now, so inflation tends to have a dual impact, right? First one is higher interest rates. Inflation will tend to sort of high interest rate because high inflation may central bank want to control that, may increase interest rate and all that, and that may result in a high interest rate, the GR rate and all that get affected. And when that happens, I stated that earlier already, that a high interest rate will mean a wider net interest margin. That's the NIM, the net interest margins temporarily. I mentioned that temporarily. I mentioned that happened in the short term because then the variable loans get repriced, right? But well, demand for loans also drop. So if demand for loans are dropping, then over time you have the NIM contracting. The second one is a real drag, right? A high inflation will mean that operating costs will surge. So like salaries, tech, and rent, and all those things are likely to rise. The banks may want to adjust their salary compensations and tech and all those kind of stuff, right? And so these are real issues that banks face, right? These are real issues that banks face. And also the loan quality deteriorates. Borrowers' repayment capacity falls because of high inflation. Think about a situation where high inflation triggers high interest rate. High interest rate triggers the fact that customers may not have the cash flows needed to even pay. And even high inflation may mean that customers' own operating costs will rise. And rising operating costs does what? It affects the cash flows of the customer. The margins of the customer may not be strong enough, so they may not be able to pay back the loan. In 2015, 2016, when we had a power crisis, the operating expense or operating cost of several companies was high, and that affected the companies. And so that affected the ability to repay loans, and that has caused NPLs to rise significantly. I recall I did a research back in the university, and I was looking at the effect of interest rates on non-performing loans or something. I did something like that. I think I plotted a linear regression. I got a linear regression and I looked at, I think it has a good R square. When I did that back then, I think in 2015, 2016, I did something like that. Now, so the loan quality deteriorates with high inflation, and not just the borrower's inability to pay, but also the real value of the loans deteriorates. You've given loan to someone, Let's say you've given 100,000 to a customer 5 years ago. The 100,000 today is nothing, right? Good. The value has dropped. Now, if you look at a graph below, this is a graph for the top 5 banks, the loan group for the top 5 banks. And I also have the GRL over the same period from 2020 to 2024. And I have the lending rate as well. So the GRL is the Ghana reference rate, right? The Ghana reference rate, you see the Ghana reference rate here. It has some close relation with the lending. When the lending rate is dropping, the average commercial bank lending rate is dropping, which is often a fees rate, right? A fees rate we're talking about. It's dropping, it drops when it rises, raising, and all that. You see the relation, a close relationship between the lending rate and the GRR, very close. Now, if you compare that to the loan growth here, quite not a very strong relationship, but then you see clearly in 2023, something we saw sometimes, some few slides ago, you will see that when the lending rate and the GR was rising, you saw the loan growth declining, right? You saw the same, you can see the same thing here. And in 2023, the interest rate started dropping, and then you start seeing the loan growth increasing. In 2023, we experienced a growth in loans for the top 5 banks. And again, the top 5 banks, I mean, the Ghana Commercial Bank, the likes of EcoBank, the likes of ABSA, which was previously called Barclays, Fidelity, and Stanbic. Those are the top 5 banks by total assets and customer deposit. Now, so the whole idea is that high inflation will benefit banks only if they can reprice loans faster than cost rise. If loans can be repriced faster than cost rise, and so this is easier for variable loans than fixed loans. Great. Let me check if there's any question in the chat. No question at the moment. I can move on. Good. Now, what I want to look at here is that I want to look at the macro shock case, and the macro. What I mean by the macro shock case here is the DDP program that affected the whole economy. And that is what I want to look up here. And now, well, so the 2022 Ghana debt crisis is what I'm looking at here. So a DDP program by the government of Ghana actually significantly affected the performance, and there's an error there, and threatened the financial health of banks. Now, so, well, that forced the Bank of Ghana to actually provide some regulatory reliefs. Not to talk about a lot of things regarding that as to whether what happened was the responsibility of Bank of Ghana or who should be responsible. But that is at our back now. It's about the future for the industry. Now, so Bank of Ghana later provided some regulatory reliefs, including reduction in the capital adequacy ratio from 13% to 10% temporarily, right? For the banking sector to recover. Now, there are some key drivers of the regulatory decision. What actually motivated Bank of Ghana? I talked about a number of these things yesterday. We discussed this at length, but I just want to say something a bit about this again. So the loan to deposit ratio, if you look at it generally from 2019 to 2023, our 47% loans, our deposit flows to loans, and then 41%, then 39%, then 37%, then 30%. Now, that doesn't mean that if 47% of deposit is given into loans, it doesn't mean that 53% goes to investment securities. Because we talked about the reserve ratio, right? Some portion of deposit must be reserved with Bank of Ghana. And it used to be 15%. In fact, all this while, it used to be 15% reserve requirement. Now, that's what the case was. And over time, you experience a deterioration. If you see, over time, the loan to deposit ratio declined. And one major explanation is that the decline was due to the fact that the banks were having an increasing appetite for investment securities. They wanted to invest more in investment securities. So the high investment in investment security actually triggers this to deteriorate. And the Bank of Ghana wants to control that. They want to move lending to private sector and also control inflation because, that the rate at which they're even chasing the banking, the government is alarming. The government debt is alarming. And that is increasing interest rate in the economy as well. And so they introduced the cash reserve ratio, and which we talked about yesterday. So the debt crisis actually had significant impact on businesses. I want you to look at this for Access Bank. So what I'm showing you here is for Access Bank. Every information here is for Access Bank. So Access Bank Ghana. So if you look at Access Bank in 2016, the capital adequacy ratio was almost zero, right? In 2016. And that was when we have the banking crisis, right? Banking sector crisis. Then we started experiencing recovery beyond 2017. The return on equity was not too bad, but it tells a story that the banks may be making a lot in terms of maybe granting loans. That time interest was really high. The banks may be getting so much in interest rate, in interest income and all that, but the bottom line is that they were not having enough capital, right? It was eating into their capital. If you look at the NPL, non-performing loans, was all-time high for Access Bank. Look at this, almost 40% non-performing loans for Access Bank around that period where we had a sector cleanup. And then over time, we started experiencing an improvement the bank started experiencing some level of improvement. 2019 was a terrible year for the bank where capital adequacy ratio actually fell below zero. That was a difficult one for the bank. But then at that time, they were still having a very high return on equity. So you see, the argument I've been making always is that the fact that return on equity is high, and that we said that return on equity has a high correlation with the value of a bank or the valuation of a company, it doesn't mean that we just take that and just close our eyes on every other thing. Otherwise, it's very easy because return on equity is high. It's about 40-something%. Why not just take return on equity of 40-something% and run away with it? Of course, this return on equity is high. The bank is doing well. That is all I'm interested in. Well, but is that a full story? You need to look at the regulatory capital as well. Because I said that, you see, if you look at how even return on equity is calculated, it's about earnings divided by equity. Now, if earnings is volatile or you experience some couple of years of good returns, of course, you have the return on equity really high. But one thing we check for a bank is the health. We look at the capital to see whether the capital is good enough and see how terrible the capital was at that time. But look at the return on equity at that time. And the NPL was also very high, right? And the NPL declined. In 2021, the bank started recovering. They were meeting their, I think, about 8%. That is their the capital adequacy ratio or something like that. If I confirm, I've not called the figures on this, otherwise we have seen the figures nicely. But then return on equity was still high. And then in 2022, it dropped significantly. It dropped significantly to negative. Then it rose again in 2023. When it dropped significantly, see what the capital adequacy ratio has done. It has improved significantly. Of course, these are some of the things that you may have to say, because at the same time, you have NPL being very low, right? So why would return on equity actually drop significantly? Of course, it may mean that you may have to decompose this return on equity to see the components of the drivers of return on equity that's actually causing this negativity here. Then an increase in 2023, significant increase in return on equity, is that spike significantly, but that came at a cost of capital adequacy ratio significantly dropping almost to zero. What at all is going on at Access Bank? Maybe that is something which you will have to take a look at to investigate further. We are using real life data because that is necessary to help us in understanding what's happening rather than just seeing a lot of theory. So every figure you see on the board here is a real life figure. It's something from the industry to look at. So this is a special case. I pick it up to tell you what happened in 2022. So 2022, the trouble in the economy caused a lot of banks to do badly. And the return on equity, one factor contributing to the negative return on equity in 2022 was the DDP program. So the significant impairment loss affected the bank as well. So that's why that has dropped significantly. The capital adequacy ratio have improved. And for me, one thing I can say is that a number of this improvement in 2022 was actually driven by the regulatory relief, right? Significantly will be driven by regulatory relief. And the regulatory relief might have increased this significantly to this figure. Um, yeah, but in 2023, you see that things normalize again. When perhaps the regulatory relief was extensively used in 2022 compared to 2023. We are yet to talk about banks. We are yet to get into the mechanics of a bank's financial statement. And we'll be doing that later. And I think from tomorrow, we'll be talking about bank's financial statement. We've not yet started talking about that. So I just want you to get that noted, that here, even though we have not started talking about bank's financial statement, I started bringing those things in so that, look, you're getting a feeling, right, of how a bank's financial statement is like. All right, great one. Any question there? I'm not sure I have any question. Please, a moment. Let me connect my laptop. I think I'm running out of battery. Just a moment. All right, I'm back. Thank you for your patience. Okay, good. So now, what we're going to be doing, um, what we're going to be doing now will be for us to look at the key drivers of a variable interest rate. I've been talking about the variable interest rate. And I want to tell you a little bit about the variable interest rate. I think there's a question in the chat. It said, Gustav, what is the criteria to, okay, Gustav, I just said Gustav, right? Thank you, Joseph. Now, I want to talk a bit about the variable interest rate. The commonest so far is the GRL in Ghana. Now, when we talk about the global market, especially when we deal with USD debts or loans that are granted, and maybe euros and all that, then we'll maybe talking about other ones. The GRL is for CD instrument, right? Now, for the USD, you tend to, and the euros and all that, there are several benchmarks like the Sonia, the SOFR. The Sonia is used in London. The SOFR is used in the United States. And, we used to have the LIBOR, but the LIBOR has been wiped away. And one of the arguments has to do with the Deutsche Bank and when people were actually giving the LIBOR, right? LIBOR has been wiped away. LIBOR used to be base is an is if you look at the SOFR is actually based on actual transactions, right? LIBOR is more of future transactions, right? The rate that the double A rated banks in the United States, in London, I think they can borrow among themselves. Of course, anybody can provide any rates, of course, and all that. But then the software tends to be based on actual transactions, so it's difficult to give, right? It's more objective. Now, the GRL, the Ghana reference rate, is used to price loans in Ghana here, in Ghana City, variable rate loans. Now, so the formula for that is it's a bit it's very simple, that not quite difficult. You understand that the the interest rate here, as I said, that the basic interest rate we have actually is the monetary policy rate. So upon that, it's built other interest rates. So it forms kind of like a building block, other interest rates that we have. And so if you look at the GRL formula, we tend to have what we call an adjusted MPR. And the MPR here is the monetary policy rate by the Bank of Ghana. And so there is a weighting applied to that to that quickly. Just a moment, please. Just a moment. One moment, please. Sorry, team. I had a bit of a, so I had to quickly look at something. Sorry about that. Um, please, can you see my screen? Is my screen visible? Is my screen visible, please? Thumbs up from somebody that the screen is visible, and that's all fine. Yeah, okay, thank you very much. Thank you very much. All right. Now, so when you take the DRL, we have something called adjusted MPR. So there's a weighting applied to MPR. That's 0.4 times the MPR, and we have an adjusted interbank rate. So this is the interbank rate that the rates of which the banks themselves borrow among themselves overnight rate, right? Overnight lending, 0.2. So a weighting of 0.2 to that. And then we have an adjusted 90-day treasury bill. So if you look at it, an adjusted 90-day treasury bill, we have 0.4 weight applied to that. And there's another additional adjustment to that. We take the 90-day treasury bill, but something else is being applied to it again, which is you have 1 divided by 1 minus the CRR. The CRR is a cash reserve ratio. We looked at the cash reserve ratio, and that is a function of the loan to deposit ratio that the bank has. So a bank that has a loan to deposit ratio less than 40% is likely to be required by the Bank of Ghana, or it will be required by Bank of Ghana to keep 25% of its deposit with the central bank, right? So ECRR then will be 25%. Now, if the bank has its loan to deposit ratio be between, I think, 40% to 55% or so, then the bank will be required to keep only 20% or reserve only 20% of its deposit with the Bank of Ghana. But if the bank loan to deposit ratio is higher than 55%, they'll be required to just reserve only 15%, which used to be the cash reserve ratio as before the revision. Now, so you see that if we have a bank, for example, a bank, and most banks in the country here, the loan to deposit ratios are less than 55%. So they'll be required to keep like a minimum of 20% of their deposit with central bank. And that deposit attracts no interest at central bank, and it's not available for lending. Now, so if you look at this formula here, you have 1 divided by 1 minus CRR minus CIV. The CIV is a cash involved, right? Now, so if you have the CRL to be, let's say, 15%, then the denominator, 1 minus the 15%, compared to a CRL of, let's say, 25%, which is 1 minus 25%, you see that the 25% one is likely to result in a lower denominator. If it results in a lower denominator because you are doing 1 minus a bigger figure, it results in a lower denominator, then is likely to result in a higher product here. 1 divided by this is likely to be higher, right? Now, because your loan to deposit ratio is lower, you are likely to, or you are required to reserve a higher amount with Bank of Ghana. If you are required to reserve a higher amount with Bank of Ghana, then 1 minus that higher amount will be lower. So the denominator is lower. And if you are dividing 1 by a ratio that is smaller, then the final result is going to be larger, right? And so the story is that generally you will be having a higher DRL if you have your CRL ratio being high. Now, well, this is not on a bank by bank basis, but then the Ghana Bankers Association and co who are involved in the estimation of the DRL will have a better story to tell. But this is at the level of the banking sector. So earlier, we saw something here. I want to go back to it. Earlier, we saw the loan to deposit ratio, and you saw that in 2019, it was 47%, and it dropped to 30% here. So this 30% here it's not even up to, it's below the minimum, right? If I say minimum, I mean, you are falling into the bucket for those banks that will have to reserve 25%. So if we take the whole sector as a bank, the sector may have to reserve 25%. So because the whole sector is not lending enough to the private sector, or the loan to deposit ratio is low, the CIR ratio that may be applied in the estimation of the GRR will be 25%. And that's why interest rate in the economy could be higher. So in other words, the central bank is trying to tell you this story, that if the banks are not lending much to the private sector, or they are not creating loans, then interest rate in the economy will be higher. In other words, it will cost you to get credit. So if the banks are doing well in terms of lending a significant proportion of their deposit out as loans, at least more than 55%, then those banks, or then the sector, is likely to have a higher loan to deposit ratio, and therefore consumers are likely to pay a lower interest rate, all other things being equal. Now you see other things here too, like the treasury bill. So the treasury bill, the MPR, and the interbank rate, those are the key variables involved in a determination of GRR. And then we have the wages applied to it. Now, interest on existing loans tend to be affected by the GRR. The introduction of these revision, the revision to the GRR got affected. Future interest rates also got affected. Higher credit risks, in that a lot of customers, people may default. But what's the story when we're talking about modeling? Don't forget, one is demand for the loans, right? But that's not the big matter. The big matter here is that when you are modeling a bank's financial statement, you should be aware that the bank's cash reserve ratio, of what the bank cash reserve ratio will be. In other words, you should be looking at the bank's average loan to deposit ratio, or the range of loan to deposit ratio that the bank is looking at. And that will affect how you model the bank. So you cannot just say that, well, you're going to model that the bank's deposit will grow by 25% because historically they've been doing something similar to that. Or maybe each peer group, they've been doing something similar to that. So we're going to have that. And when we have something around 25%, and then we are going to increase loans, or we are going to increase investment securities, or we are going to do this, we are going to do that. We are going to move 85% of the money to loans or whatever, or to investment securities or whatever. You need to know that you can lend out all the money. You need to reserve some money. So you can't just increase deposits on a bank's balance sheet and then you keep you learn all of them. No, it doesn't work like that. So it has applications in modeling, and those are some of the controls we are going to set in the models that we're going to be building. Yeah, definitely that's what we're going to do. Now, so let me check if there's any question about three. Okay, is there a question? Okay. Tony said we had a USD loan which was indexed against GRR. Do you think it was a fair arrangement? A USD loan indexed against GRR, how? Because the GRR rate itself, is a CD rate. Because think about it. How? I'm wondering, because if I look at the decomposition of the GRR, we have MPR. MPR is reflecting the monetary conditions of the country. Ghana cedi here, right? Interbank lending rates, or interbank rate, also a CD rate, right? And so why would that be used for USD? I'm wondering. Okay, if anybody has a contribution or maybe something to say regarding that, you can put that in the chat. What Tony said. All right, we have some few minutes to end the lecture, and if you've been following at least from yesterday, we tried to finish on time, right? Yeah, so we promised to finish by 7:30. We get it done by the 7:30. Now, so stick with me as we go through this. I want to talk about something now. We finished the first part on the macroeconomic issues. I want to talk a little bit about bank profitability drivers. Just a little bit about bank profitability driver. Now, you see, the key item of the bank P&L that drives its profitability is a net interest margin. Now, so the net interest margin, and I've been talking about net interest margin for quite some time now, and I think by now, you know exactly what I'm talking about. But here I'm bringing out a formula. I want to say something about it. And in later sessions, we're going to talk a lot about them. You see, I began bringing things out bit by bit so that when you see them later, they don't appear as things that are strange to you. The net interest margin is determined as follows. We have the interest income that comes from the loans and investment securities, and we have the interest expense. So when you take out the interest expense from interest income, that gives you what we call a net interest income. And then you take net interest income divided by the average earning asset, and that gives you the name. I use the word average. What we do, we don't tend to discourage the use of end of year or end of period earning asset balance. And here, earning assets, I mentioned earlier yesterday, is the loans and advances to customers and also investment securities, right? So the average year means, let's say we are calculating the net interest margin for 2023. The average earning asset year means earning assets of 2022 and earning assets of 2023, then I take the average. Why is that important? That is important because think about a bank that has, at the beginning of the year, they have an asset base. I mean, if I say an asset base, I mean the loans and advances and investment securities. They have an asset base of, let's say, 5 million. At the end of the year, they have an asset base of 7 million. If you want to calculate net interest margin, if you express the net interest income over the year-end balance, which is the 7 million, you may not get a better response because the extra 2 million adding to the 5 million at the beginning of the year might have come in maybe some loans written in October, November, December. So they've not been in with the bank throughout the year to earn income. They might have just earned the bank income maybe just 1 month or 2 months or something. So we don't want to just use the year end. We want to use the average. So picking the beginning balance and picking the end balance, and then you average that, that becomes the denominator. Now, so when we talk about interest income, when we say interest income, which you see on the P&L, I showed you yesterday, the interest income is the interest accrued on the earning assets, the interest accrued on the earning assets of the bank. And when we say interest accrued, it suggests that what you see on the P&L as interest income is not the actual interest the bank receives. That is what is accrued. This accrual concept, right? Just as in industrial corporates, we have the revenue, and part of the revenue may be credit sales, and some may be cash sales. But whether credit or cash, once it meets the definition of revenue, we record it, right? The same thing happens with the banks. The interest income you see on the P&L may not be the actual cash received from customers with respect to interest payment. Okay. Now, so it's a bit difficult. Like, sometimes when you pick a bank's balance sheet and you feel like that you can just calculate some things on the face of the balance sheet and P&L, you may be wrong. There are a lot of things that are going on there, and we are going to talk about them. And you need to understand these things really well to be able to effectively model a bank's financial statement. If you take interest income, we say they are generated from where? The investment securities and loans. Now, when we are accruing interest income, we accrue it on the gross loan, not on the net loans. Okay, so when I say that interest accrued on earning asset, I don't mean on net earning asset. I mean on the gross. We accrue it on gross. Now, when you want to record this on the financial statement, the accounting is not that difficult, right? But I want to simplify things a bit. I'm not going to be too comprehensive. I'll just give you an overview today. So when loans are written, we consider those things being posted to the gross loans ledger, right? So we have the gross loans. I don't want to use accounting terms too, so I will not use things like debit and credit. I'll rather use the terms of analysis like increase, decrease, and that's what I'll do. Now, so we have the gross loans. To transition from gross loan to net loans, there are several adjustments that the banks pass. Number one, when the loans are granted, you know very well interest is accrued on those loans. when interest is accrued, then later interest are paid. So when interest is accrued on the loans, then the accrued interest is added to the value of the loans, and then later interest are paid. Sometimes some of these interest accrued may be placed on suspense because of the fact that the customer may not pay, right? Maybe there could be potential default and all that. So there could be interest, some interest being in suspense account, right? They are accrued. When they are accrued, they're added to the gross loan, but they may be in suspense account. So later we need to adjust those interests on the gross loan. Now, so when a customer pays, of course, that's also then we adjust the gross loan, right? We also have impairments, potential credit losses, right? So those also will be adjusted. You adjust the gross loan by impairment as well. And also when there are repayment of loans, we adjust the gross loans, right? So after passing all these adjustments and things, then we'll end up arriving at the net loans. And we are going to do the work. When we start looking at the bank financial statement, we're going to go through all stuff, right? Great. That is the first one. The second one is the interest expense. Because when I was talking about the NIM, I said the NIM is interest income minus interest expense. So we talk about interest income, we talk about average earning asset. And I said that interest is accrued on the gross and not on the net. And I want to talk about the interest expense. So interest expense here, these are interests actually accrued on the interest-bearing liabilities of the bank. And this includes deposits and borrowings on the bank. So generally represent the cost of funding. How much does it cost the bank to fund its asset? So money is raised from deposit sources and borrowings, and that is used to fund the asset, right? Now, often banks deposits just like the loans and even the investment securities, where I didn't really talk a lot about those sides, maybe grew by class. So we may have class of loans, or maybe in this case we could call it loan products. Okay, loan product. It could be term loans. We could have term loans. We have overdraft. And in most banks, we have staff loans, right? They could have those kind of categories of loans. When we talk about, or when we come to the deposits, since to get interest expense is a matter of taking a deposit and applying a rate. When we get to the deposit side, we may have classes, right, of deposits. And the commonest you all know is the CASA. And CASA is current account, savings account. And it's considered the cheapest because people can actually withdraw money from the account anytime they want to withdraw money. There's no restriction, right, on the CASA. So therefore, the savings account, even the interest it generates, is extremely minimal. But current account tends to generate significant. Also, there is no interest charged on the current account. The one that attracts interest to customers, to depositors, significant interest is the time deposit, right? Good. It's out of the time deposit. And what I want to say, maybe on the next slide, I'll come back to talk about the net interest margin again. There's something special I want to talk about there under something. And so, again, like something we saw under the loans, the movement in the deposit. So you cannot just go to the balance sheet and pick the deposit and say, well, between 2021 and 2022, deposit has increased by 1 million. So that's the actual cash that has come to the bank. That's the actual deposit the bank has mobilized. No. That may be wrong. Because when interest is accrued on the deposits too, and they are not paid to the customer, or there's a delay in the payment or anything of that sort, then the deposit that you see on the balance sheet may not be, or the increase in deposit there may not be entirely there, the deposits mobilized from the public. You need to know that. Very, very important. And we are going to model all these things out, right? So it's going to be easier. So the interest expense again on the P&L is represent the accrued interest and not what has been paid. Right? What has been paid is in the cash flow statement. What is on the P&L is what is accrued. And when I did my analysis, and so working with banks and all that on banks' financial statement for a long time now, it's common for you to see that about 95% of the interest accrued get realized as interest received. if we take the interest received on a cash flow statement and express it as percentage of the interest accrued on the P&L, about 95% of it is received. So it's quite good, right? That's why when I'm doing modeling, sometimes I don't want to worry myself too much. I will say, well, it depends on what I'm doing. I will say, well, I want to assume that going forward, over the forecast or period, whatsoever they accrued is whatever they receive. It goes to the cash flow statement. I'm going to sleep. Now, that is it. I think there's a question in the chat. Let me look at that. How about gains and losses on forex trading, FS trading? Yeah, the gains and losses on FS trading are also, they are not part of the net interest margin. They are part of the what we call the non-funded income base of the bank. And we'll look at this soon. Are these classified as other income? No, they are not classified as other income. They are not classified as other income. In fact, the gains and losses on FS trading, which we call the net trading income, component of the net trading income, they actually revenue to the bank. I talk about the various revenue sources of a bank. I think I said interest income is one. We have net trading income, and the last one is fee and commission income, right? Now, let's, I don't think there's any other question. We almost done. We left with about some 10 minutes to finish, and you'll be finished by then. Now, when we look at the net interest income margin again, I want to say something more here. So the net interest income is a significant driver of bank's profitability. We established that. Now, the stability and sustainability of the net interest income is a function of the bank's effectiveness in implementing its asset liability management policy. And I talked about this yesterday. You see, you need to be able to manage the liability which are driving the interest expense and manage the assets which are generating the interest income. If you can manage the two, you tend to have your net interest margin being stable. When the case studies that we'll be doing, when we look at a bank's financial statement and we look at the net interest margin over time, you compare to see which bank is actually managing its net interest margin properly, or in other words, which bank is adopting an effective asset liability management policy. The interest income is a function of the quality of asset held by the bank and the general level of interest rate in the economy. Now, because we don't charge, even though I said that we charge interest on gross loan, we don't just charge interest on any gross loan at all. The father is gross, so we charge interest on it. Now, it depends on how the loan has been classified. For credit purposes, some loans may be removed from the books for the purpose of the computation of interest or accrual of interest. Interest may not be accrued on those loans. So the quality of asset matters here. And the general level of interest in the economy matters because we apply the rates to that. Now, so the ability to actually earn good returns on assets is measured by the earning asset yield. So you see the earning asset yield here, which is the average earning asset, which is the interest income divided by the average earning asset. So you often hear earning asset yield. And when we do bank forecasting, especially for the P&L, when we are forecasting interest income, we will tend to use that as an earning asset yield for the forecast. We don't use CAGR. I'm saying again, we don't use year-on-year growth to forecast interest income on the P&L. No. There are better measures to use, but an approximation is the earning yield. Let me tell you about a better measure. The best way, or the true yield on the earning assets, the loans and investment security, is not the historical earning yield that I've been talking about. What I've been talking about is the historical earnings yield. A better measure is the IRR of the asset portfolio cash flows. So what I mean by IRR, I'll talk about it later. I'm going to tell you more about the IRR later. But here, we're going to put all the loans together in a portfolio and look at the loan cash flow as a single portfolio, and then we calculate the IRR of that. And that is the true yield. And that's the yield we will actually use to do this. And in some cases, you hear the term effective interest rate or the effective yield. That's what it means. That's the yield we use. Because everybody coming to take loans is going to do so at a different interest rate. Customers can negotiate their yield. So it's difficult to actually come up with a single interest rate that you use. So the IRR is the best measure. However, we're going to be using a lot of historical yields. And the historical yields are good, right? And you realize that they are good when used. Any question before we move on to almost to say the last slide to close it on that? I talked about funded income sources. All this while I've been talking about funded income sources. And if the funded income sources, those have to do with the ones driven by the balance sheet funding. The balance sheet funded them, like the yield on earning assets, the interest income. And so here we're going to look at the aspect of the income sources that are not funded by the balance sheet. They are non-funded income sources. Sometimes we call them non-interest income. But of course, the reason why I don't like to use the non-interest income is because when I use the abbreviation NII, is the same as the same thing I use for net interest income, which is also NII. So the non-funded income, a lot of practitioners tend to use that. Here, the sources include the fee and commission income, net trading income, and other income. And I talked about earlier. So the question asked earlier, the other set of income, the net trading income is not part, right? It sits on its own on the bank's P&L. So fee and commission here arises from the bank's transactional services to customers. So if I conducted a lot of historical analysis of these income sources. And one thing I realized is that it's mostly stable, right? The fee and commission tend to be stable, especially for the top banks. It tends to be stable. Stable doesn't mean it's constant. What I mean is that it grows at a steady rate, right? The net trading income tend to be extremely volatile. Think about it. You are trading fixed income instruments and FS trading. Like this, especially FS trading, these are speculative activities and then direction and setting in most cases. So it's quite volatile. So when you see on the P&L, most of the time it's volatile. So you see, forecasting this sometimes is very challenging, and I'll suggest a way to forecasting that when we look into the details. Other income sources are any other income that is not classified under the above. And I want to say that the interest income, the fee and commission income, and the net trading income together comprise of they constitute what we call the revenue of the bank. The interest income, the fee and commission income, and the net trading income, they constitute the revenue of the bank. And the other income components is not part of revenue of the bank. I defined revenue yesterday as the income from the ordinary activity of the bank. Now, a ratio we often use a lot in financial analysis of a bank and also for valuation purpose is the non-funded income to total income ratio. So you don't expect this ratio to be too high. For me, if this ratio is above 30%, it suggests that the bank's earnings are not of good quality. I expect it to be good. Mostly, you see it around 23%, 24%, 25% for most banks, right? A lot of banks in the market. That's what you tend to see on the market then. Is there a question? And so that's brought us to the end of today. Today, we talked about a number of stuff. We talked about economics of banking, and there we looked at how economic variables affect the performance of banks. And so the economic variables to say, we talked about GDP, we talked about inflation, we talked about exchange rates, and we talk about also interest rates, right? Now, we looked at the impact on the sector and by extension, the various banks, and how some banks could be affected depending on the level of exposure they have to do those economic variables. We went ahead to talk about some key drivers of bank profitability. I noted some few stuff, and also I talked about some accounting issues about how some items are accounted for, and for you to have just some basic understanding to the balance sheet, even in P&L, even before we start tackling those things in later sessions. And it's been a great time I have with you. And before we close it, just as I do all the time, I wanted to write something in the chat box. Let me see about how impressed you are about today and what you have learned today, and how happy you will be to stick around to learn more in future sessions. So let me have something. Everyone write something. Just write something. I want to read something for everyone. Great staff, good. Yeah, Mavis, Lodina. I want to read. Very impressed. Great content, useful, great. The competition of GR very insightful. Yeah, great explanation, Julius Nelson. From Nelson out there. Yeah, I want more. I want more comments. Don't leave. Wait, we have not closed yet. Great explanation, great lesson, very informative session. Thank you all. You've stick around. That's wonderful. I've learned a lot. Thank you very much. I love the FS exposure session. Seems to be very key. And this is free. It's free. Eh? A hot point that's rising interest rate trigger currency depreciation. In an ideal world, I think I answered that question, right? Another insightful section, I particularly appreciated the breakdown of the GRR calculation and how CRR factors in. Great delivery, indeed a masterclass. Great job, Julius. Thank you. Matilda, that was great lesson. Learned so much from this lesson. Thank you so much. Learning new things. I am glad. Great. I'm glad you're learning new things. Actually, the whole idea is that I don't think knowledge have to be expensive. Yeah, but then we want to see how we can help each and everyone. Okay, so at this point, Ifree, is there something to say before we close the lecture for today? Let's have Ifree. And hi, Ifree, are you there?
Yes, Julius, I am here. Hi.
Good. Hi.
Okay, nothing much from me, just to say thank you once again. And then for all participants, thank you for joining us, and join us again tomorrow for the day 3 of this masterclass. Thank you and see you tomorrow.
Great, thank you. Many people are still typing, and that's wonderful. I really appreciate your time. I was sticking around, and that was a great one. Great, thank you very much, guys. Good night.